Let's move on to another issue. I know it's front and centre for so many people. And that's, of course, this extraordinary increase in property values rising at their fastest pace in almost 17 years, with low interest rates, of course, and Commonwealth and state COVID support programs leading to a surge in new home loans. Almost $29 billion worth of home loans were written in January, 1 month alone, as top economists warn the Reserve Bank may be forced to consider raising interest rates. For more on this, I'm joined now from Melbourne by the Chief Economist at My Housing Market, Dr Andrew Wilson. Dr Wilson, thanks for joining me tonight. I want to put some of these numbers up in black and white for my viewers at home. According to CoreLogic, Sydney's median house price is $1.06 million. That's up almost 5% over the last 3 months. Melbourne's median price has climbed 4% to almost $830,000. This is, of course, in the middle of a recession, Andrew, and a lot of job uncertainty, we're told. So what's happening here?
Well, we shouldn't be too surprised, Peter, at the rate of growth that we've recorded this year so far. Housing markets have been recovering since the end of the coronavirus shutdowns last autumn, and of course prices growth has accelerated. And even the Melbourne market, which had those September shutdowns, recorded strong growth by the end of the year. So it's just an acceleration of what we've seen, a revival in the market. And really, I think that we need to understand that house prices in Sydney and Melbourne, even though they have increased sharply, are just back to where they were in 2017. And of course, that's the key to why we are seeing house price growth, and that's that affordability still remains positive.
We're getting a lot of growth, though, in regional areas. Now, is that because people are forced out of the CBD and the cities of our bigger cities, bigger capital cities, or is it because, in part, having the experience of working from home and businesses now being more accepting of that fact, people want a bit more life balance?
I think that'll be a short-term factor, Peter, in terms of house price growth. I think that gradually, as normality returns to our capital cities, we'll see that ease. But there's no doubt that there has been a shift to larger regional centres. But I do think that over the longer term, a lack of infrastructure will moderate that. But there's no doubt that affordability is a positive now in particularly Melbourne and Sydney. Even though prices are still where they were 3 years ago, we've seen a 1% cut in mortgage rates and a 6% cut in a 6% rise in wages. And this, of course, means that buyers are up and about and prices are rising.
Give me a sense of where the RBA will go, because the Governor, Phil Lowe, said earlier this month that interest rates would stay on hold, he said, these sort of record lows until 2024. I know some are concerned about the market overheating, the property market. Where do you think the RBA will go?
I don't think there's a role for the RBA here, Peter. The last thing we'd want would be higher interest rates. Of course, we still have a fragile economic recovery and, our dollar already strong would go through the roof with any increase in interest rates. I think the RBA's role is to ensure that there's responsible lending from banks. They've stated that. And as long as our banks are maintaining their credit restrictions, I think that we'll see an orderly adjustment to our housing markets this year, and I think gradually we'll see a decline in the house price growth now, which really is all about catching up rather than some sort of overheated market bubble.
And is this flowing through the sales here to the investment market? There was some concern over Christmas of lack of rental stock. We know a lot of older Australians are concerned about returns, bank rate returns and also market volatility. Is that where some of this movement is coming from?
Well, I think one of the differences in the market environment at the moment, Peter, is that we still have very low numbers of investors. And again, that means that there's less risky lending happening. If we look back to 2017, when we had strong prices growth before the market tanked, we had around 60% of the market or 40% of the market were investors. Now we're down to 20%, which is a record low. It's owner-occupiers that are driving this market at the moment. 60% of the market are owner-occupiers, and we've never seen these numbers from owner-occupiers before in terms of loans being approved, and that's certainly a less risky element, and I think that's something that the Reserve Bank will be aware of, that it's not an investor-driven market at the moment. It's certainly one driven by owner-occupiers.
All right, and just in general terms, we've got the federal budget coming out in May. I think if we were asking ourselves at the start of this crisis whether we'd be out of it so quickly, I don't think anyone would have been so optimistic. This time last year, but I think there's a lot more optimism today. Where do you think things are headed this year?
Well, certainly the momentum is upwards, and we've got to be aware that the market, that our economy is still struggling. Our unemployment rate has fallen down to 6.4%, but it was in the low fives before coronavirus hit us, and we really need to be moving with a 4 in front of our unemployment rate to start feeling that we're back to even thinking about prosperity in the Australian economy. So a lot of hard yards to go. But the direction is certainly positive, and I think that we're just about the envy of the world of how we've not only handled coronavirus, but how our economy has performed as well.
Well, let's hope it continues. Chief Economist at My Housing Market, Dr. Andrew Wilson, thanks for your time.
Thank you, Peter.